Zoetis is one of the biggest animal healthcare companies in the world. The company generates strong cash flow, maintains high margins, and has historically delivered impressive returns on capital. So why has the stock fallen so hard? Is the market overreacting to a temporary slowdown? Or is this the beginning of a deeper structural problem? Today, we're going to break down Zoetis' business model, competitive moat, financial quality, and valuation to see whether this beaten-down compounder could become a long-term opportunity for investors. Zoetis is the global leader in animal healthcare and one of the most dominant companies in the industry. Originally spun off from Pfizer in 2013, the company focuses exclusively on medicines, vaccines, diagnostics, and healthcare products for animals. Zoetis operates across two major segments: companion animals, such as dogs and cats, and livestock, including cattle, poultry, swine, and fish. What makes the business especially attractive is its diversified portfolio and recurring demand. Pet owners continue to spend on healthcare, while livestock producers rely on animal health products to improve productivity and disease prevention. Today, Zoetis sells products in more than 100 countries and has built deep relationships with veterinarians, clinics, distributors, and large farming operations around the world. This global scale, combined with strong brand trust and high regulatory barriers, has helped Zoetis become one of the highest quality businesses in the healthcare sector. Zoetis is widely recognized as the global leader in animal healthcare, controlling an estimated market share of around 15% to 20% of the global animal health industry, depending on the segment and region. The company competes against several major players, including Elanco, Merck Animal Health, Boehringer Ingelheim, Ceva Santé Animale, and Virbac. However, despite the competition, Zoetis consistently stands out because of its scale, profitability, product diversity, and deep relationships with veterinarians worldwide. One of Zoetis' biggest advantages is its broad portfolio. Unlike smaller competitors that rely heavily on a few products, Zoetis operates across vaccines, dermatology, pain management, parasiticides, diagnostics, genetics, and livestock solutions. The company also benefits from strong pricing power. Its products are often considered mission-critical for veterinarians and livestock producers, making customers less sensitive to price increases compared to other healthcare segments. Another key competitive advantage is Zoetis' relationship with veterinarians. Veterinary clinics tend to stay loyal to trusted brands because switching treatments involves medical risk, retraining, and uncertainty in treatment outcomes. On top of that, the animal healthcare industry has high regulatory barriers. Developing animal medicines requires years of research, clinical testing, regulatory approvals, manufacturing expertise, and global distribution networks. This creates a significant moat that protects large established players like Zoetis. Financially, Zoetis also outperforms many competitors. The company consistently generates higher margins, stronger free cash flow, and superior returns on invested capital compared to most peers in the industry. In many ways, Zoetis is not just another pharmaceutical company. It has become one of the premium compounders in healthcare, combining defensive demand, recurring revenue characteristics, and long-term global growth potential. Zoetis reported first quarter fiscal year 2026 revenue of approximately $2.26 billion, representing 3% year-over-year growth. Adjusted diluted earnings per share came in at $1.53, while adjusted net income remained solid despite a slower operating environment. The company continued to demonstrate strong profitability across the business. Gross margin remained above 70%, reflecting Zoetis' premium product portfolio, pricing power, and efficient operating structure. Operating margins also stayed healthy, highlighting the resilience of the company's business model even during periods of softer demand. From a segment perspective, companion animal products remain the company's largest revenue contributor, although growth moderated compared to previous years. Management cited softer veterinary visits and more cautious consumer spending trends in the United States. Meanwhile, livestock revenue remained relatively stable, supported by continued demand for animal health products across global agricultural markets. Zoetis also maintained strong cash generation during the quarter, supported by its high-margin business model and recurring demand characteristics. However, management updated its full-year fiscal 2026 guidance, lowering revenue expectations to a range of approximately $9.68 billion to $9.96 billion and adjusted EPS guidance to around $6.85 to $7 per share. Overall, while growth slowed compared to the company's historical pace, Zoetis continued to demonstrate many of the financial characteristics associated with a high-quality compounder. Strong margins, durable profitability, healthy cash generation, and resilient long-term business economics. Following the earnings report, Zoetis shares experienced a sharp sell-off as investors reacted negatively to slowing growth and weaker forward guidance. While the company remained highly profitable, the market was focused on something far more important. The possibility that Zoetis' long-term growth story might be slowing down. For years, investors viewed Zoetis as a premium defensive compounder, a business capable of delivering stable growth, strong margins, recurring demand, and resilient earnings even during economic uncertainty. Because of that reputation, the stock historically traded at a premium valuation compared to many healthcare companies. However, during the quarter, several psychological concerns began to emerge among investors. First, weakness in the companion animal segment raised fears that pet healthcare spending may not be as recession-resistant as previously believed. Management noted softer veterinary visits and more cautious consumer behavior, particularly in the United States. Second, the company lowered full-year guidance, which signaled to the market that slower growth could persist longer than expected. This combination created a major shift in investor psychology. When a stock is priced as a high-quality compounder, the market expects consistency. Even a small slowdown in growth can trigger a disproportionate reaction because investors begin reassessing how much premium valuation the business truly deserves. In other words, the market was not reacting to collapsing profitability. Instead, investors were reacting to the fear of slower long-term growth, multiple compression, and the possibility that Zoetis may no longer deserve its historically premium valuation. As a result, the stock experienced a sharp valuation reset despite the company still generating strong margins, healthy cash flow, and solid profitability. This is a common pattern among premium compounder stocks. When expectations are extremely high, even a modest disappointment can lead to a severe market reaction. Now, let's take a look at some of Zoetis' key financial ratios for fiscal years 2025 and 2024. Zoetis reported a gross margin of 71.84% in fiscal year 2025, improving from 70.62% in fiscal year 2024. This is an important indicator because it highlights the company's strong pricing power and premium product positioning. Even during a slower growth environment, Zoetis was still able to maintain exceptionally high profitability levels, which suggests that its products continue to hold significant value for veterinarians and livestock producers. Next, return on invested capital, or ROIC, increased from 22.19% in 2024 to 24.42% in 2025. This is particularly impressive because ROIC measures how efficiently a company turns invested capital into profits. A ROIC above 20% is already considered elite in most industries, and Zoetis continuing to improve at this level demonstrates the strength of its business model and capital efficiency. Free cash flow margin also improved year-over-year, rising from 23.97% in fiscal year 2024 to 28.41% in fiscal year 2025. This means Zoetis converted a larger portion of its revenue into actual free cash flow, which is critical for long-term shareholder value creation. Strong free cash flow gives the company flexibility to invest in research and development, acquisitions, share repurchases, and future growth initiatives. Finally, interest coverage improved from 12 times in 2024 to 14 times in 2025. This indicates that Zoetis remains financially healthy and comfortably capable of covering its interest expenses through operating income. A higher interest coverage ratio also reflects improving financial stability and lower balance sheet risk. Overall, despite concerns surrounding slower growth, Zoetis continued to demonstrate many of the financial characteristics associated with a high-quality compounder. Strong margins, elite returns on capital, robust cash flow generation, and solid financial strength. Despite the recent slowdown, several positive catalysts could support Zoetis' long-term growth outlook over the coming years. First, the global animal healthcare industry continues to benefit from long-term secular trends. Pet ownership has increased significantly over the past decade, and many pet owners now treat animals as family members, leading to higher spending on healthcare, nutrition, diagnostics, and preventive treatments. Second, Zoetis still maintains strong pricing power supported by its premium product portfolio and deep veterinarian relationships. Even during periods of softer demand, the company continues to generate gross margins above 70%, highlighting the strength of its business model. Another important catalyst is innovation. Zoetis continues investing heavily in research and development, particularly in areas such as dermatology, pain management, vaccines, diagnostics, and precision animal health. New product launches and expanded treatment platforms could help re-accelerate growth over time. The company also benefits from its highly diversified business structure. Zoetis operates across companion animals, livestock, vaccines, parasiticides, diagnostics, and genetics, reducing dependence on any single product category or market segment. International expansion could also become a meaningful growth driver. As pet ownership and protein demand continue rising globally, especially in emerging markets, Zoetis has opportunities to expand both its companion animal and livestock businesses internationally. Financially, Zoetis remains in a strong position. The company continues generating robust free cash flow, high returns on invested capital, and healthy profitability, giving management flexibility to reinvest in future growth initiatives while also supporting shareholder returns. Perhaps most importantly, Zoetis still possesses many of the core characteristics associated with long-term compounders. Strong market leadership, durable competitive advantages, recurring demand, premium margins, and resilient cash generation. If growth stabilizes and investor confidence eventually returns, the current valuation reset could potentially create a more attractive long-term entry point for patient investors. Despite Zoetis' strong business quality, investors should also pay attention to several long-term risks that could pressure the company's future growth and valuation. One important risk is increasing competition within the animal healthcare industry. Large competitors such as Elanco, Merck Animal Health, and Boehringer Ingelheim continue investing aggressively in new products, vaccines, diagnostics, and treatment platforms. Over time, stronger competition could place pressure on market share, pricing, and future margins. Another risk involves patent expirations and generic competition. As certain products mature, Zoetis may face lower-cost alternatives entering the market, particularly in more commoditized treatment categories. This could gradually reduce pricing power in selected product segments. Regulatory risk is also an important factor. Perhaps most importantly, Zoetis still possesses many of the core characteristics associated with long-term compounders. Strong market leadership, durable competitive advantages, recurring demand, premium margins, and resilient cash generation. If growth stabilizes and investor confidence eventually returns, the current valuation reset could potentially create a more attractive long-term entry point for patient investors. Animal healthcare products require strict regulatory approvals across multiple countries. Changes in regulations, product safety concerns, manufacturing compliance issues, or delays in approvals could negatively impact future product launches and operational efficiency. Currency fluctuations could also create pressure on financial results. Because Zoetis operates globally, foreign exchange volatility may impact revenue growth and profitability, especially during periods of strong US dollar appreciation. In addition, livestock markets can remain cyclical and vulnerable to external disruptions such as disease outbreaks, trade restrictions, changing agricultural policies, and fluctuations in global protein demand. Finally, although Zoetis remains a high-quality company, maintaining premium valuation multiples over the long term may become more challenging if the company transitions from a high-growth compounder into a more mature, slower-growing business. For long-term investors, the key question is not whether Zoetis is a good company, because financially it clearly is, but rather whether the company can continue sustaining enough innovation, growth, and pricing power to justify premium valuations over time. Now let's take a look at Zoetis valuation. The company's estimated fair value is around $224 per share, while the stock is currently trading far below that level. Through fiscal year 2025, Zoetis continued to demonstrate strong growth, high profitability, and solid value creation for shareholders, reflecting management's ability to build a durable long-term business. However, fiscal year 2026 remains challenging, with management lowering revenue guidance due to softer demand. Still, beneath the near-term uncertainty, long-term investors may see a potential opportunity emerging from the current market weakness. In conclusion, Zoetis remains one of the highest quality businesses in the animal healthcare industry. The company continues to demonstrate strong profitability, high returns on invested capital, durable cash flow generation, and a business model supported by powerful long-term trends. While fiscal year 2026 may remain challenging due to slower demand and weaker near-term growth expectations, the long-term fundamentals of the business still appear solid. The recent market sell-off reflects investor concerns about slowing growth and valuation compression, but it may also create opportunities for patient long-term investors. Ultimately, the key question is not whether Zoetis is a great company, because financially, it clearly is, but whether today's market pessimism has created a more attractive long-term entry point. As always, investors should remain disciplined, focus on business quality, and carefully balance both risk and opportunity before making any investment decision. This content is for educational purposes only and does not represent financial advice. Thank you for watching, and don't forget to like and subscribe for more insights.